All right, if you're an investor, you know what I'm talking about. That dividend tax form shows up in the mail, and it can be a real head-scratcher. But you know what? It doesn't have to be. Let's decode this thing together.
Seriously, have you ever just stared at a Form 1099 DIV and felt totally lost? If you have, you are definitely not alone. It's just a sea of boxes, numbers, and jargon. It really does feel like a secret code. But here's the good news. It's a puzzle we can totally solve. I promise by the end of this, you're going to know exactly what those boxes mean and, more importantly, how they actually impact your wallet. We're going to go from confusion to clarity, step by step. Okay, first things first. Let's get right to the most important thing on this entire form. It really all boils down to two main types of dividends. You've got ordinary and you've got qualified. So an ordinary dividend, just think of this as the default setting, the standard payout. A company makes some money, they share those profits with you, the shareholder, boom, that's typically what you get. It's kind of the baseline for the IRS.
And just like that, we've solved the first piece of the puzzle. If you look at your form, you'll see the total amount of these payouts right there in box 1A. It's even labeled Total Ordinary Dividends. See? Nice and straightforward.
Okay, but this is where it gets really interesting. Some of those ordinary dividends, they can get a special qualified status. And trust me, this is a huge deal for your taxes. Why? Well, ordinary dividends get taxed at your regular income rate, just like your paycheck. But qualified dividends? Oh, they get taxed at the much lower long-term capital gains rates. We're talking 0%, 15%, or 20%. The takeaway here couldn't be simpler. The more qualified dividends you have, the less you pay in taxes. Period. So that obviously leads to the million-dollar question, right? How in the world does a dividend get this awesome tax-advantaged status? Well, it's not random. There are very specific rules you have to meet. All right, let's dive into the rules of the game. The IRS has a little checklist, a few tests, to see if your dividends make the cut for that lower tax rate. Basically, there are three main hurdles to clear. First, the payout has to come from a U.S. corporation or a qualified foreign one. Pretty simple. Second, it can't be one of a few specific types of payments that aren't allowed, like, say, from a credit union, because those are technically interest. And then there's the third one, and this is the biggie, the one that trips everybody up. You have to meet the holding period requirement. So yeah, we're going to focus right in on that holding period. Why? Because it's the rule that you, the investor, actually have some control over. But it's also the most complicated. Nailing this part is absolutely key. Okay, to get this holding rule, you just need to remember two numbers. The first one is 121. The IRS sets up this special 121-day window, and that window is centered around something called the ex-dividend date. That's just a fancy term for the cutoff day you have to own a stock by to actually get the dividend. So think of it as a 121-day zone right around that important date. So this window is your playing field for getting that qualified status. It officially kicks off 60 days before the ex-dividend date. To even have a shot, the time you own the stock has to fall somewhere inside this 121-day block. And now for this second magic number, you have to own that stock for more than 60 days inside that 121-day window. I'm going to say that again, more than 60, so 61 days or more. And there's a really good reason for this rule, right? It's all about rewarding long-term investors. The IRS doesn't want people just jumping in, grabbing the dividend and jumping right out to get a tax break. They want you to have some skin in the game.
Okay, let's switch gears for a second. We've totally cracked the code on the profit side of things, but sometimes a company sends you money that, well, isn't profit at all. It's a whole different animal, and it's called a return of capital.
So the official stuffy IRS name for this is a non-dividend distribution. All that means is that the money didn't come from the company's recent earnings. But honestly, the much better name is return of capital, because that's exactly what it is, and it works totally differently. Here's the easiest way to think about it. The company's not giving you a piece of its new profits. It's literally just handing you back a little bit of the money you used to buy the stock in the first place.
Let's run through a super quick example. It'll make this crystal clear. Imagine you go and buy one share of a stock for exactly $100.
Okay, so that $100, that's your cost basis. And this is a super important number you got to track for taxes, because it's the starting line for figuring out your profit or your loss whenever you decide to sell. All right, now fast forward a bit. The company sends you a $20 payment. You grab your 1099 DIV, and you see that $20 shows up in box 3. That's your clue. Box 3 means it's a return of capital.
So what do you do with that 20 bucks? Well, you don't pay tax on it as income right now. Instead, you just subtract it from your original cost. So your cost basis, which started at 100, is now down to 80. You basically just got a little bit of your original investment back ahead of schedule.
And this is the really important part. You didn't get any taxable income, you just got your own money back. The tax hit is just deferred, it's pushed down the road. Because when you do finally sell that stock, your profit is going to be calculated from that new, lower $80 basis. And that means, yeah, your taxable gain will be bigger then.
All right, we've gone through all the big pieces of the 1099 DIV puzzle, so let's put it all together now in one quick, simple wrap-up.
Think of this as your go-to cheat sheet. First up, you've got your qualified dividends. That's company profit, and it's taxed at those nice low capital gains rates. Then you got your regular ordinary dividends. Still company profit, but this time it's taxed at your higher regular income rate. And finally, that return of capital. That's just getting your own investment money back. Not taxed today, but it does lower your cost basis for when you sell later on.
And there you have it. The code is officially cracked. Now you can actually look at a 1099 div and know the story it's telling you. And look, this is about more than just filling out a tax form, right? It's about really understanding how your investments are paying you. So I'll leave you with this question. Now that you know some dividends are taxed way less than others, are you going to start looking not just at how big a dividend is, but at its quality? Something to think about. Thanks for joining me.